Hello everyone, this is Paris. Welcome to Budgetholics. If you're interested in making money while you sleep, dividend stocks are one way to go. And in this video, we're going to talk about the 5 best dividend stocks to buy in November 2021. If you're interested in personal finance, investing, and wealth building, please hit the like button and subscribe, as this really helps me with the YouTube algorithm, and it's a free way to support the channel. Before we get started, don't be confused, I'm not a certified financial advisor or planner, and this video is just a list of my picks and should not be confused with any sort of advice regarding what investments you should make. If you need help when investing, speak to a certified professional. Without further ado, let's jump right into it. By the way, today's list is in no particular order. These are 5 solid companies that I'll be buying during November. At number 5, we've got Pfizer. Pfizer is a pharmaceutical giant. They're one of the first companies that released the vaccine, and they've been in business for decades. Pfizer is currently trading at $43.05 per share. They've got a market cap of $242.1 billion and a P ratio of 18.44. They have a payout ratio of 70.64%, and they have a 5-year annualized dividend growth rate of 1.79%. They've been growing their dividend for 12 consecutive years, and the yield currently sits at 3.63%. In terms of earnings, they've been beating analysts' estimates consistently, and overall they've been increasing both their earnings and their revenue in the past 4 quarters. Currently, 67% of analysts recommend that Pfizer is just a hold, with only 34% recommending that it's a buy. I also consider Pfizer to be a buy, despite some recent troubles they have had. The average analyst's price target is $46.45, which is just 7% above what Pfizer is trading right now. The reason I put Pfizer in today's list is that I believe it's trading at a fair price, it pays its dividend consistently, and it's coming out with new product when the demand for them arises. The recent vaccine is just one example. Of course, there are other pharmaceutical companies worth considering, which I've also added in my portfolio and in previous lists. You can find the full playlist of previous dividend stock picks here and down in the description, and Pfizer is one of them. At number 4, we've got 3M trading in the New York Stock Exchange with ticker symbol MMM. If you take a look around your house or your office, depending on where you watch this video, I hope not the bathroom, you will almost surely find something produced by 3M. They make almost everything from post-its to these things that stick to the back of your phone and then you can hold them. I'll leave a picture. 3M is trading for $179.84 per share. They have a market cap of $102.7 billion and are currently trading at a P ratio of 17.79. They have a payout ratio of 58.46%, which is below the 40 to 60% we're usually looking for, and a 5-year annualized dividend growth rate of more than 43%. They've been growing their dividend for 49 consecutive years, which makes them a dividend king, and currently have a dividend yield of 3.29%. 3M has been beating analysts' earnings estimates for the past 4 quarters, and their revenue has also been increasing in the same quarters. Again, as with Pfizer, most analysts think 3M is a hold, however, I'll be buying, and the average analyst's price target is $191.4 per share, which is an expected increase of around 6.4%. However, keep in mind that these are not growth stocks, these are dividend stocks, and they are picks made to pay you a decent dividend. At number 3, we've got Walgreens Boots Alliance trading in the NASDAQ with ticker symbol WBA. This company was formed after Walgreens bought out Boots, which is a UK drug retailer, and naturally they operate across both Europe and the United States. Recently, the Village MD program, which is a primary care facility next to Walgreens, was launched, and the company has high expectations both in terms of paying dividends and in terms of growing. Currently, WBA trades at $47.25 per share, and they have a market cap of $40.7 billion. They trade at a P ratio of 20.48, and they have a payout ratio of 81.74%. I admit that's a bit too risky, but I'm allowed 1 or 2 risky picks now and then. They have a 5-year annualized dividend growth rate of 32.62%, and they've been growing their dividend for 46 consecutive years. I'm sure they're trying to obtain the dividend king status, so I think the dividend will be safe. Then again, I'm just a random guy on YouTube. What do I know? In terms of dividend, they currently yield 4.05%. WBA has been beating analysts' earnings estimates for the past 4 quarters, and their revenue has also been increasing. Currently, most analysts believe WBA is a hold. However, the average analyst price target is 53.13 per share, which is an increase of around 12.44%. That's more than the average annual growth of the S&P 500, and keep in mind they're also paying a 4% dividend. That's why they're also on the list. At number 2, we've got the Toronto Dominion Bank trading in the New York Stock Exchange with ticker symbol TD. If you've been watching this list, you know I love Canadian banks. They're solid companies that don't take too much risk. TD is the second largest Canadian bank after the Royal Bank of Canada, and it currently trades at $71.69 per share. They have a market cap of $132.3 billion US and a P ratio of 10.62. They have a current payout ratio of 37.22% and a 5-year annualized dividend growth rate of 43.71%. They weren't able to increase their dividend. As you saw, the payout ratio is quite low because of some regulations regarding restrictions due to the recent illness. However, the current dividend yield is 3.49%. TD have been beating analysts' earnings estimates for the past 4 quarters, and their revenue has been relatively stable. Most analysts believe TD is currently a buy, with the average analyst price target at $75.68 per share. This is an expected growth of 3.76%. Finally, at number 1, we've got Verizon Communications trading in the New York Stock Exchange with ticker symbol VZ. Verizon is one of the 3 largest 5G providers in the US, along with AT&T and T-Mobile. As you can see, the stock of both 3 companies has been declining in the past 3 months. And although T-Mobile acquired Sprint, and many consider this to be the next great 5G company, I believe Verizon is also a good pick. Both Verizon and AT&T offloaded their media business and can now compete on equal terms on the 5G race. Currently, Verizon trades at $52.69 per share. They have a market cap of $217.8 billion, and they have a P ratio of only 9.89. The current payout ratio is 47.42%, close to the lower limit of 40% we're usually looking for, which means the dividend is pretty safe and they still have money to reinvest into the company, and the 5-year annualized dividend growth rate of 11.63%. They've been growing their dividend for 15 years, and currently they yield a dividend of 4.86%. Verizon has been beating analysts' earnings estimates for the past 4 quarters, although admittedly Q1 2021 was a close call, and their revenue has been quite stable since Q4 2020. Most analysts believe Verizon is a hold, with the average analyst price target being at $60.15, which is around 14% above what Verizon is currently trading at. This was my list of the 5 best dividend stocks to buy now in November 2021. If you enjoyed this video, make sure to hit the like and subscribe buttons and let me know down in the comments what dividend companies you're buying. If you want to get 1 free stock, you can sign up to Freedom 24 using the link down in the description, where you can also find some additional sign-up links for Revolut, a free online bank, and a couple of crypto platforms. Until we meet again, don't stop investing. Cheers.